This program is brought to you by the National Association of Insurance and Financial Advisors, promoting political advocacy, education, and the ethical conduct of its members nationwide.
Financial planning begins and ends with income planning. We have a nation of people who are financially better prepared to die than to live. They are better prepared to protect all of their assets except for their most valuable asset, their income. In this presentation, Mark and Ryan Petersen will explain how to use motivation, emotion, and strategy to make selling disability insurance an integral part of your daily business. Petersen International Underwriters is a Lloyd's of London cover holder who underwrites special risks for the disability market.
America is a cash society. Does anyone today think they can stop spending money? You could jump in bed, cover your head, grit your teeth, and say, I'm not going to spend any more money. I'm out of budget. It won't work because from the moment of birth until the moment of death, those of us who live in cash societies, such as America, must spend money.
During our lifetimes, every day, every hour, every moment, we must spend money in order to live. We long ago forgot how to make a living by hunting and gathering. So this cost of life goes on like the electric meters in our homes. It turns incessantly, sometimes faster, sometimes slower, but it never stops. We have a choice: spend money or die.
Our first illustration is fondly known as the Hardesty Curve, named after a family friend, Russ Hardesty. You see, Russ was one of the few people we've known that actually started his career with the same firm that he retired from. So it is his career pattern and earning curve that matches this chart. The chart illustrates his lifeline from birth to death. It shows his income earning curve, whereby in the first 20 or so years of life, he, like most of us, depended upon someone else to furnish us with the money and the care we need to live. Therefore, we show very little or no income at all during those early years of life. But then sometime in our early to mid-20s, we're supposed to spread our wings and get out of the nest and start making an income on our own. It is this hard-earned income that is supposed to offset the financial cost involved to live in our cash society.
So we were out of school, and we start earning an income in our early 20s. Probably modest wages at first, but as the Hardesty Curve suggests, the income level continues to increase as we grow in our jobs, professions, and careers. Then, as we reach our mid-50s, our incomes will typically tend to level off a bit until we reach our retirement age. Retirement age in the U.S. has for many decades been the target of 65. Recently, retirement age has become a moving target as retirement plans have failed to live up to objectives set out by many retirement planners. Even our government is realizing the additional factors such as mortality are affecting Social Security retirement plans, and today, age 67 seems to have become the new target.
So we work hard to earn a living, and just when we have the hang of doing this career thing and our income levels are at their peak, we're supposed to stop working and then settle for a little lesser income, which we've learned to adornedly call retirement income. It is part of the great American dream, and this dream is indeed possible if we discipline ourselves at an early age to set aside adequate amounts of money that we can earn for purposes of building a savings that will grow to a size that becomes large enough so we will not have to work to earn an income any longer. This is, of course, money at work. And that was indeed the fortune of Russ Hardesty's working life, his earning curve and his retirement years, all planned out and matching this nice, smooth graph.
Russ, of course, is an exception to most Americans. Many of us become infected with the entrepreneurial spirit, and so we look around and say, hey, if I can make money for the boss, I can make money for myself. Then we read the grim statistics from the Chamber of Commerce showing that 95 out of every 100 entrepreneurial endeavors in America fail. They fail for a number of reasons, such as lack of proper capital, lack of management skills, or perhaps uncontrollable situations, such as changes in laws or regulations. These failures will create a bump in their Hardesty curve, but given time, they can recover and begin to smooth out their curve once again. These bumps are not limited to the self-employed. Those who choose to work for someone else and their hopes in creating their own Hardesty curve oftentimes face similar obstacles. Mergers and acquisitions may find redundancy of jobs with terminations following. The firms themselves may fail financially. The point to make is that these problems can normally be solved provided the person has the ability to work and find a new job.
Exactly, the ability to work. There is, of course, a very real and fairly high probability that a disability may cause similar bumps and perhaps even larger bumps in this road to retirement. What happens when the curve ends up being jagged instead of the nice smooth curve like the Hardesty Curve? Plans have to change. We're going to have to use money that was intended for other purposes in order to exist between these bumps. These bumps may indeed rob the hopes and dreams of the future and the funding that was designed for the retirement plan.
In the disability insurance sales world, there is an old two-line chart that most of us have seen somewhere in our insurance education. It is such a simple way to explain the need for income replacement that it should not be forgotten. Let me illustrate it here. If we accept the idea that life is just a cash flow, then we can look at the green top line labeled income in relation to the red line below, which represents expenses. As long as we have an income greater than expenses, life is simple and savings can take place. But as previously mentioned, bumps in the road do happen. They can be problems such as being terminated from employment, or they can be something just as disruptive, a premature death or a serious illness or injury. If the bump is caused by a disability, it will make the expense line head north, and just as quickly, the income line will plummet south. Once those two lines intersect, that person is now faced with the four-letter word most of us have come to fear: debt. So we know that a type of debt insurance plan called medical insurance can help to control the northbound expense line. But that is only half of the solution because the income line is still headed south. The complete solution when an injury or illness strikes is to support the income line with disability insurance and suppress the expense line with the use of medical debt insurance. This will keep the income line above the expense line and keep the insured out of debt.
There are two problems created by the very living of life which we have no control. We just have to recognize that we may face these problems, and when they occur, they will create a significant economic problem unless we're financially prepared for them. One of those problems, of course, is premature death, which cuts our cash flow completely and immediately. Premature death quickly invades the money that we were supposed to have generated and earned for our family. As insurance professionals, we must remember that the basis of life insurance in its original form was income replacement and not something that was designed for the convenience of the taxman. Now, the second problem, of course, is becoming sick or hurt and not being able to work to earn an income. Disability is oftentimes referred to as the living death. Economically, the living death is a greater concern than dead death due to the simple fact that the disabled person is still alive. He or she does not have 6 feet of dirt or sod over their bodies. Therefore, they will remain a consumer. More times than not, they become even a greater consumer due to the additional needs that a disabled person typically requires.
So we bring up the fact that insurance is the answer to eliminate the possible economic consequences of a premature death or disability. When we review the statistics, we discover that Americans are better prepared to die than they are to become disabled. This chart illustrates the fact that 78% of American households have some sort of life insurance compared to less than 30% with some sort of disability protection. Yet the chances of a person becoming disabled far exceed the chances of a premature death. If you are 30 years old, the chances of becoming disabled prior to age 65 versus dying before age 65 are almost 7 times greater. They are 4 times greater at age 40 and 3 times greater at age 50. It appears we have an industry that may be prescribing the wrong sequence of products. This should be considered a form of malpractice. How will your client take the news when he learns that he survived his illness or accident, but because he did not die, the life insurance you sold him will be of no use in providing him the income that he and his family need? Did you ever talk to him about disability insurance?
I recently read a real-life story published in NAFA's Advisor Today that gave me reason for thought. It was a very moving story about a young family coming home from a dinner with relatives when suddenly their car was hit broadside. Fortunately, the 2 children only suffered minor injuries, but the father had many serious injuries while the mother did not survive the accident. The family's insurance agent then told the prelude to this terrible accident, and she described how she had sold life insurance policy to the father, who was the sole breadwinner for this young family. She had suggested a life insurance policy on the wife as well, but her clients argued this was not needed because she was a stay-at-home mother. Now, because of the insurance agent's fortitude, she was able to convince the husband that it was important for the wife to be insured, and as the husband explained it, they finally relinquished and bought a $250,000 term life insurance policy on the wife, just to quiet the agent. Now, the bad news, of course, was the mother was killed in the accident. The good news was that her life insurance policy was in place, which would prove to be the sole source of income for this family. You see, the husband was so seriously hurt that he could no longer work to earn a living. After I read this moving story, I decided to send a letter to the editor, which was then published the following month in Advisor Today. My letter was entitled, "Thank God Teresa Died." Now, some called my headline disgusting, but my point was very important, because if the wife had survived the accident, the family would have had no source of income because the agent had not presented her clients the idea of disability insurance. Or if she had suggested disability insurance, she did not use the same fortitude to convince the husband that income protection was just as important, if not more important, than the life insurance.
Now, all insurance is important, of course, but much like doctors who prescribe medicine to make their patients feel better and to live more healthy lives, professional insurance agents prescribe insurance products along with financial planning advice to help their clients secure their financial futures. Financial planning begins and ends with income planning, for without income, there really cannot be a plan. We are on a crusade to change the prescription patterns in our industry. We would like to share with you the disturbing insurance selling patterns that we find today.
The National Association of Insurance and Financial Advisors, NAIFA, yes, the organization that produced this video you're watching, solicited our firm to advertise in their excellent publication entitled Advisor Today. They had provided us a media kit that included a survey from the readers illustrating what insurance products their readers sold. It showed that 95% of the readers sold life insurance, which was to be expected. 90% sold retirement products, 82% medical insurance, 64% long-term care, and in dead last place was disability insurance at 57%. Just slightly more than half of the readers.
Sometimes we need to ask ourselves as insurance advisors, are we nothing more than order takers selling what people ask for? Or are we professional practitioners whose job is to consult, explain, and design a solid plan of income protection for our clients? I oftentimes remind consumers that there are two general types of insurance, debt insurance and income insurance. Debt insurance is designed to reduce or eliminate the insured's out-of-pocket expenses. Examples of debt insurance include homeowners insurance, auto insurance, and medical insurance. Income insurance, on the other hand, is designed to pay the insured the lost income they will suffer in the event of a death or disability. The income insurance plans are fewer in number when compared to debt insurance plans. They are disability insurance, critical illness insurance, and life insurance. In the simplest terms, income insurance pays you, the insured. Debt insurance pays someone else providing a service.
Except for disability, critical illness, and life insurance, all other types of insurance are indeed only debt insurance plans. So we discover that Americans are not protecting their incomes as they should be. To illustrate further, I'd like to refer to a recent Northwestern Mutual survey, whereby the first question asked of the people partaking in this survey was, would you be financially devastated if your home burnt down? 88% of the people in the survey said yes, they would. Of the 88% who said it would be devastating, 73% indicated that they had purchased debt insurance, called homeowners insurance, to protect them from this potential financial devastation. Now, most people believe their home to be their greatest asset, and the protection of that asset with insurance certainly makes sense. As professional advisors, we're quick to point out that their ability to earn an income is really and truly their greatest asset. But the same logic that plays to insuring their home also plays to insuring their income. In fact, you should discuss the irony of this situation with your clients. The irony is that their mortgage company that kindly lent them the money they needed to buy their home underwrote their qualifications based on their ability to pay the loan back. It was their income that allowed for the loan. Then why is it that lenders insist on homeowners insurance to be in place and very rarely ever require income insurance to be in place?
In the next hour, 57 homes will burn down, but 1,027 people will become disabled. Income insurance has an 18 times greater chance of being needed than debt insurance. This is one of the reasons that income insurance is more expensive. It is consequently also harder to sell. During the survey, when asked if they would be financially devastated if a car accident totaled their automobile, only 49% said this was a major financial concern, yet 88% of people had auto insurance in place. Now, we know that many states demand that every driver must have auto insurance in order to drive on their roads. Certain state governments are so worried about our ability to repair the cars that got damaged that they pass laws stating that debt insurance must be purchased in order to drive on the roads. If we borrow money to buy a car, like the mortgages on our homes, the auto lenders also demand debt insurance be in place prior to releasing the funds to buy the car. Income is what qualifies you for the loan, but again, income insurance is not usually required by the lender.
Statistically, only 1 out of every 70 automobiles are involved in an accident, but 7 out of every 10 people will suffer a disability during their working career. Out of those 7, 1 of them will have a disability that will last more than 5 years. That means there is a 7 times greater chance of becoming disabled for 5 years or longer than getting into an auto accident. I profess that lenders are asking for the wrong type of insurance.
Another question on the survey was extremely interesting to me. When the survey asked if they would be devastated should a very expensive vacation be canceled due to a sickness or accident, 24% said this would be devastating to them, and an astonishing 23% bought trip cancellation insurance to protect against this situation. Of all the insurances in the survey, this scenario had the highest ratio when comparing concern of risk to insurance purchased.
Now, the final question in the Northwestern Mutual Survey asked if you would be financially devastated if you were to become disabled and could not earn an income. 78% stated that this would be financially devastating, yet only 10% had bought insurance to protect them from this type of financial disaster, less than any other type of insurance mentioned in the survey. Trip cancellation outscored disability insurance by more than 2 times. Americans' priorities are messed up. Isn't it interesting that people in the survey were smart enough to recognize the potential devastation that a disability would cause, because 78% stated this would be a problem, yet only 10% did anything about it. This tells me that we've failed at our jobs as insurance professionals. We must make a much stronger effort to educate and persuade the American workers to the fact that income insurance is more important than any debt insurance that they currently own.
That is so true. But you know, the carpenters and plumbers and electricians in our country are certainly thankful that homeowners have debt insurance to cover their homes. It guarantees them to get paid to rebuild those homes that are lost to fire or other damage. But even though the house burnt down and the homeowner's insurance is paying to have it rebuilt, the borrower must still make the mortgage payments during the rebuilding process. Similarly, physicians and surgeons are just as thankful for medical insurance because it guarantees their incomes. Yet even as you lie in a hospital bed, unable to work, you must still pay your household bills, and medical insurance does not do that for you. Debt insurance plans rarely have waiver of premiums. Deductibles and coinsurance are other examples of expenses that are not covered by debt insurance, and all must be paid from either income or savings.
Medical insurance is my favorite to point out issues with. We can see that the American people have certainly been swayed as to how they should spend their hard-earned money for insurance. Now, who has swayed them? Doctors and hospital administrators? Perhaps. They've done a tremendous job of building this concept in the American people's minds that medical insurance is an absolute necessity. I know that my next statement here will be controversial, but I would suggest that we don't really need professional insurance agents to sell medical insurance. Medical insurance has made itself into an asked-for commodity. When was the last time you had a client that you actually had to sit them down and sell them on the idea of buying medical insurance? More than likely, your conversation was based on the affordability of medical insurance and what you could do to perhaps make it more affordable. After all, 85% of Americans own some form of medical insurance already, and the other 15% would probably own it if they could afford it or qualify for it. So the primary efforts of today's health insurance agents has become that of an advisor that can direct the consumer to the proper product in regards to price and benefits. Now, I must say that medical insurance is a comforting device. It proves very valuable as an economic planning tool. But what is the result of the ownership of medical insurance program for which people have voluntarily reached down into their pocket, taken out their hard-earned dollars and shelled out $4,000, $6,000, $10,000 a year in premium? Well, one thing they have absolutely guaranteed is the living standards of the hospital administrators, the doctors who treat them, big pharmaceuticals, and really anyone in the medical field.
In 1937, Baylor University professors invented Blue Cross. And then in 1949, a group of General Electric engineers invented major medical insurance. It was a brand new industry and soon became the largest premium producing segment of the insurance world. By 1990, 85% of all Americans were covered by some form of medical insurance, while only 27% had their incomes insured. Many medical bills could probably be paid out of pocket. If they are larger bills, perhaps it may take some time to pay off, and that is provided the individual has the ability to earn an income. Medical insurance is just another form of debt insurance, and like the homeowners or the auto insurance, it does not keep the insured totally out of debt. Between deductibles, co-insurance, limits on certain procedures, out-of-network expenses, ineligible expenses, and so on, the list is long, and the uncovered debt is much often greater than one would expect.
As an industry that sells insurance products and dispenses financial planning advice, we should remind people that their point of focus should not be where medical expenses stop, but rather where the income line crosses the expense line and the opposite of savings takes place. Remember that dirty four-letter word, debt? Let's be sure to point out in our medical insurance consultations with our clients that extra money is going to be needed to cover expenses not fully covered by medical insurance. This extra money will need to come from your savings, and to replace one's savings requires income. Paying off debt also requires income. So let me ask you, do you have your income protected? As we have already mentioned, income protection is by far the most undersold insurance product today.
Now, the debt model introduced to our society many years ago is not all bad. Going into debt allows us to afford certain luxuries in life when we do not have the immediate funds available on hand. Lenders are willing to give us money now as opposed to waiting until we have saved enough, provided we have a source of income giving us the ability to repay them. So the question becomes, have we saved enough money specifically for the possibility of a disability? I found inspiration from Einstein and his theory that no two particles of matter can occupy the same space at the same time. It seems to me that no unit of money can be used for two different purposes, and each must be funded on its own. So, if our savings has been designated for wealth creation, for retirement income, or for some other purpose, it cannot also be designated for long-term or even short-term disability situations. Hopefully your clients will have enough saved to see them through a disabling event, and that they have time to replenish their savings before another disabling event follows. A Census Bureau study reveals that a typical 35-year-old making $50,000 annual salary has enough savings on hand to cover only 2 months of expenses. How long did it take to save that much? Well, if they were able to save 10% of their monthly income, the answer is 20 months of saving to have 2 months of rainy day funds available. It would take 5 years to save only 6 months and 10 years to have saved a year's worth of income. The bottom line is it takes a long time to save.
Could they borrow money? Banks don't loan money to people based on their net worth. They only loan money to people who have an income statement that is supportive of the fact that the individual will be able to repay the loan out of their future income. What about government assistance? After all, our government has long been concerned about their citizens' loss of income. They were looking after us in 1908 with the passage of workers' compensation, then in 1919 with unemployment insurance. 1935 brought about Social Security retirement income, and finally, it was not until 1956 that our government recognized the need for income protection plan should a person become sick or hurt, which was not necessarily related to a work accident. So they added disability income to the Social Security retirement plan. With most government plans, the intent is always good, but the results are often far from satisfactory. If you suffer a disability, hopefully you will be one of the 32% of all Social Security claims that are approved, and if approved, hopefully the average benefit of $900 per month is enough to cover your expenses. A little sidebar note here. If a private insurance company only approved 32% of all of their claims, the government would have shut them down. So without an adequate savings or the ability to borrow money or collect satisfactory benefits from the government, that only leaves family and charity to rely on, unless, of course, one was prudent enough to purchase disability insurance.
There are a crazy number of statistics that have been amassed over the years to point people in the direction of what type of insurance they should buy. Statistics are developed to help us understand the needs and the costs involved in protecting assets. However, statistics are not crystal balls that can predict what will happen, when it will happen, and to whom it will happen. Statistics point out that it is only a probability that a person will become disabled, and this may be one of the reasons that selling income protection is a more difficult job than, say, life insurance, because we know that death is a certainty. But sharing statistics about disability can help us tell the story of why we need to insure against its probability. In 2008, the Council of Disability Awareness conducted a worker disability planning and preparedness study and determined that 48% of working Americans would only be able to survive financially for 3 or less months. An additional 27% advised that they could not make it a year without some source of income. According to the Bureau of Labor Statistics, 73 million Americans reported that they spend their money as follows. Around 30% of their income goes to housing, 19.6% for transportation, 16.6% goes to food, 8.6% is discretionary spending, another 8.6% on personal insurance and pensions, 5.5% goes to clothing, 4.6% on entertainment, 4.4% on health care, and 1.5% on education. Additionally, a Federal Reserve survey reported of all the income-producing persons in the United States, regardless of their income, on average are able to live within 6 weeks of personal bankruptcy. People just tend to spend most of what they earn.
Our industry has recognized for years that an adequate replacement of income in the event of a disability is between 65 and 75%. This percentage of replacement is needed in order to maintain their current living style. We also know this from third-party research and surveys. We teach this in LUTC, RHU, and LOMA, the American College, and for many years, our long-term disability carriers have always set the maximum benefits at 2/3 of income replacement. Now, proper levels of income replacement are essential in the prescription of disability insurance benefits. Disability insurance should be something more than just a minimal benefit providing bread and water and a tent in the park. When you buy replacement value auto insurance, you expect to be able to replace your Cadillac with another Cadillac. Income earners need to expect the same in their time of need. They need to know that their lifestyle will not be too adversely affected. In school, I was taught that the human body, as to its chemical content, is worth about $1.68. Now, adjusted for inflation, I would guess that would probably be about $5 today, depending upon the commodity market, of course. But the human body at work is like a machine producing income month after month and year after year, and is indeed worth a lot more than the $5. The human body at work is a true asset and one that should be insured. By and large, our industry neglects to put the same thought process to the living death as we do to the actual death. We tend to ignore the importance of selling our clients on the absolute need for income protection. I would like to suggest that opening doors and obtaining interviews can well be achieved if you learn to lead with disability insurance. The idea of protecting a person's paycheck or the income flow to their business does indeed open eyes and ears.
Now let's test your disability knowledge. Don't worry, this won't be graded. It's just an exercise for you to see how much you know about disability statistics. Number 1, how long does the average long-term disability absence from work last? Is it A, 6 months, B, 1 year, C, 1.5 years, or D, 2.5 years? The answer is D, 2.5 years. Number 2, what percentage of disabilities are not work-related in America? Is it A, 35%, B, 50%, C, 65%, or D, 90%? The answer is D, 90%.
So much for those who thought workers' comp was the answer.
Number 3, what percentage of initial Social Security disability applications were approved in 2009? Is it A, 35%, B, 50%, C, 65%, or D, 90%? The answer is A, 35%. Number 4, what are the chances that an employee entering the workforce will experience a disability prior to retirement? Is it A, 1 in 3, B, 1 in 7, C, 1 in 10, or D, 1 in 20? The answer is A, 1 in 3. Number 5, what are the chances of a long-term disability being the result of an accident? Is it A, 1 in 3, B, 1 in 7, C, 1 in 10, or D, 1 in 20? The answer is C, 1 in 10.
Remember that an accident-only plan is not proper coverage. True or false? 100 million American workers are without private disability insurance. Answer, true. Do you think this is a big enough market for you? 7. True or false? Over 50 million Americans classify themselves as fully or partially disabled. Answer, true. Number 8, true or false? 70% of American employees live paycheck to paycheck without enough savings to cushion the financial blow of a disability. Answer, true. 9, true or false? Working men are more likely to become disabled than working women. Answer, false. Among workers with disabilities in the U.S., 52% are women. 10, true or false? More mortgage foreclosures are caused by premature death than disability. Answer, false. Disability causes nearly 50% of foreclosures, while premature death only causes about 2%. Well, how did you do? Some of the answers are quite surprising, aren't they?
The dynamics of the disability market far exceed that of the personal needs for disability insurance. There are 3 general categories for disability insurance: personal disability, which may be individual or group; business disability insurance plans protecting the livelihood of not only the owner of the firm, but the employees and the stockholders; and a catch-all category that we simply refer to as special use coverage. We would like to communicate a conceptual approach to these different plans as opposed to going through the mundane details of actual benefit design and policy definitions.
Personal disability insurance is the most commonly prescribed disability plan today. Perhaps the most important factor when prescribing personal disability insurance is that a proper and adequate level of income is replaced. Being underinsured can be as painful as not being insured at all. Based on what we discussed earlier, we know that the spending patterns of Americans is the same regardless of the level of income they earn.
So we have a problem in our industry that relates to the high-level income earners in America. People earning $50,000 a year oftentimes have no sense of sympathy for those that earn $250,000 or more a year. But the reality is that these people will suffer the same financial consequences should a disability cut through their ability to earn an income. These people have proportionately larger mortgages, more expensive automobiles, second homes, private schools for their children, and so on. The objective of disability insurance is to shore up the lifestyle of the insured, whoever they may be. This diagram illustrates what happens in the traditional disability insurance market. The objective is to insure about 2/3 of a person's income. This is achievable up to a level of income around $100,000 to $125,000. But as a person's income increases, the actual replacement of income begins to decrease. This leaves a gap for the higher income earners, which needs to be filled with a supplemental disability plan. Recognizing what the need line is, 65 to 75% of income replacement, alternative markets must be sought out to find this level of coverage. There are plans that can offer supplemental coverage filling in this insurance protection gap with monthly benefits that can be issued in addition to what they currently may have, providing an additional $10,000, $50,000, even $100,000 per month. Think of your high income earning clients who may have secured all that they can get from the traditional market in regards to income protection. This area of business will open many doors for you.
Supplemental or excess coverage is not limited to personal disability, though. Needs are often found in uninsured or underinsured business buy-sell plans, business overhead expense plans, and key person plans. All of these fall into a category known as business disability insurance. In the traditional market, the limits for buy-sell disability insurance often fall short of the actual need. Questioning your client can raise the concern of underinsurance issues and where the funding would come from in the event of a partner becoming disabled. Communicating the idea that being in business with a disabled partner would not be the most pleasant situation. It may not even be financially feasible and the business could fail. This type of conversation may very well motivate your clients to secure buy-sell insurance. Just imagine your disabled partner is sitting at home worried about how he is going to financially survive and wondering if you, his partner, is taking advantage of his absence. The answer to this concern is a properly constructed exit plan. The buy-sell agreement is a way to guarantee the insured's value of the business, provided it is properly funded either through cash flow of the business or more smartly through disability insurance. The design of the agreement is critical to pay attention to. We have seen cases where a buy-sell agreement may have called for the selling of shares from one partner to the other following a 12-month period. Yet the insurance was prescribed and issued with a 24-month waiting period. You may know that traditional disability carriers often allow for larger benefits provided there is a longer elimination period, and so an agent may see this as a solution for obtaining the benefit amount needed. Or perhaps the agreement calls for an immediate payout, a lump sum, following a certain period of time. But the funding mechanism called buy-sell disability insurance was wrongly prescribed with a monthly installment payment. These situations that I just described may be grounds for an error and omission claim. When a case like this presents itself, the proper solution can often be found in the non-traditional market. Large benefit amounts of 5, 10, 25, 50 million or more with an elimination period to match the buy-sell agreement and a matching lump sum or monthly payout as per the agreement. The prescription needs to match the agreement. It is very, very important. Again, this is an excellent conversation starter. Ask your clients and prospects if you can review their buy-sell agreement. If your client does not have a buy-sell agreement, it's a perfect opportunity to offer your services to help them create one.
Business overhead expense disability insurance handles the business owner who has one income but two budgets and creates a financial backstop for them. The personal budget is protected by personal disability insurance, but the business budget is still vulnerable. The self-employed person has to be concerned with how he or she would pay the rent, the utilities, employee salaries, and of course the list of ongoing expenses that cannot be instantly shut off just because the insured is disabled. In the traditional market, the maximum monthly benefit is often less than what is required to meet that monthly expense nut for the business. Using the supplemental disability approach, additional BOE coverage can be prescribed to fit nicely on top of the underlying coverage. Examples include doctors with their own clinics, when expenses can reach over $100,000 a month, or dental offices with lots of back office employees to maintain the daily activities of the practice. But such employees would still be at a dead standstill if the dentist were unable to work and supervise. Business overhead disability insurance is a nice calling card for you and your personal service-oriented clients in that the premiums are tax deductible. And because the benefits are used to pay for business expenses, The benefits wash right through the books on a non-taxable basis. That can certainly get the attention of your clients.
One of my favorite plans to assist with the cash flow of a business that has a vital employee who may suddenly become disabled is key person disability insurance. Now, this type of insurance has the ability to get the attention of a business owner very quickly. Let's say, for an example, a venture capital firm is putting up $1 million to fund a software engineer who is developing a new program. This new program is the engineer's brainchild, and without him being able to perform his services, the entire investment could be in jeopardy. Or perhaps the law firm that have particular partners who are the rainmakers. They are the people that have the contacts to acquire the large cases for their firm. Or perhaps the foreign national that has the political connections allowing an American firm to set up shop in their country. These are all cases that need key person disability coverage. So just like key person life insurance, key person disability insurance provides the firm with a flat indemnity which can be used in any way the firm sees fit. It may be needed to repay the venture capital firm, keep the law firm's cash flow intact during the rainmaker's recovery, or allow enough cash for replacement of the foreign national that is needed to make the U.S. firm successful overseas.
We're starting to run out of time here, and we would like to mention some of the special use disability coverages in which the non-traditional market can help professional agents solve problems that may cause financial hardships for their clients. Bank loan indemnification allows business loans or leases to be insured in the event that the guarantor of the loan or lease is disabled and not able to produce the revenue needed to repay the loan. Contract guarantee ensures that the employment or other type of contractual agreement is able to be completed in the event that a disability disrupts its course. Severance agreements are sometimes necessary, but when a firm terminates an employee with the promise to continue their disability insurance, it can be a very expensive liability for the firm. Pension completion allows for the protection of a planned retirement savings against the threat of being cut off early due to a disability.
Under this title of special uses, we would like to advise about coverage such as war and terrorism. People who take jobs in areas of conflict often find they're either not eligible for disability coverage, or if they already have coverage, oftentimes it excludes or limits benefits in the event of a war or terrorist situation. Non-traditional disability markets are available to assist with this type of problem. Some of the cases we've seen include reporters, engineers, oil workers, firefighters, medical care providers, as well as many logistic managers for firms helping to rebuild or support workers in war zones.
So we would like to leave you today with the answer to a very simple question. Who should buy disability insurance?
Anyone who works for an income needs disability insurance. Thank you for your attention, and please, sell more income protection insurance. American workers are in need.
Thank you for participating in this program. For more information regarding products, programs, services, and other NAIFA member benefits, visit www.naifa.org.